Okay, great. I think we're ready. Good. Well, hello, everyone. I am Matt Coyle, and I'm with my partner and colleague, Ying Coyle. Hey, Ying, how you doing?
Hi, Matt. Good. How are you?
Ying and I are local real estate agents at Compass Real Estate, serving the Metro West region of Massachusetts. And we have a special guest today. His name is Rob Veneziano. Hey, Rob, how you doing?
Hi, Matt. Hi, Ying. Thanks for the invitation. Appreciate it.
Thanks, Rob.
Glad. Actually, you're in Florida right now, aren't you?
I am. Yes. I don't make that public knowledge. Because then people think
I'm sorry. I
no,
apologize.
I'm joking. Then people think I'm on the beach not working, and that's certainly not the case, especially with this market. We need to be on our toes and ready. But I am. It's the first time I'm snowbirding in my life. I thought I'd try it out. It was COVID inspired in some ways because, the joke is COVID is not in Florida. But of course, we know it well is. And yeah, just working remotely, enjoying walking my dog in nice weather and not dealing with the snow for winter. So it's nice.
We're all jealous. So enjoyed it. We'll try and make this video short. It'll only be 2 or 3 hours. I'm just kidding around.
Exactly. You're cutting into my beach time.
Exactly. So Rob joined us today because he is a senior loan officer at Fairway Independent Mortgage, and we had a lot of interest in the topic of mortgage loans, what the process is, and what are some of the obstacles in getting one today, especially since we have a very dynamic, I guess, macroeconomic environment with inflation, rising interest rates, and it's causing a lot of stir within the, I guess, the home buyer community, since they're the ones at risk here. So, Bob, maybe we can start off with what's the difference between a pre-approval and a pre-qualification? Two terms that are thrown around,
right? And often not correctly too, or people think they're interchangeable and the same. And speaking of dog, there we go. Think they're the same thing. So the difference is really pre-approval is the gold standard. If you're going to make an offer, you want to be pre-approved, which means the lender is going to review your data that you typically enter in through their website, pull credit. Typically, credit's good for 3 to 4 months, depending on the lender's policy. And then the lender also reviews your personal financial documents like pay stubs, W-2s, bank statements, etc. That is the way to do the best practices for a pre-approval, I should say. Pre-qualification means I still have my borrowers still submit their information, but we don't pull credit, we don't review the documents. It's just something I do a lot, by the way, in January, February, where people are thinking of maybe getting into the market. It might not be until June or the fall or even next year, but they're just planning ahead. So they get very worried about their credit being pulled. They don't want to submit all their documents just to have a general conversation of, could this work for us? That's a pre-qualification. And pre-qualification is a great first step for a lot of people. And then if they're ready to pull the trigger, then they move to pre-approval.
Let me ask a stupid question here. Why would I want to do a pre-qualification? Why wouldn't I just want to go straight to the gold standard? Just to know for certain.
Yeah, great question. If you're not ready, right? Some people just want to see if they do qualify, if the payment makes sense to them, because maybe the payment doesn't, and it could make them house poor. And they say, oh, we didn't realize. A lot of people think, they can buy a $500,000 house and they have a $1,200 a month payment. Well, we know that's not the case. And they say, well, wow, I'm paying $1,500 in rent. I don't want to, this doesn't make sense to me, whatever. They're thinking they're going to get a very different payment perhaps. So I think it's a combination of putting their toe in the water to make sure, again, that the payment makes sense, that maybe their job history has been a bit spotty. So they want to sound that out to make sure there's no challenges with maybe where assets came from, job history, maybe even credit score. The credit might be less than perfect, and they want to talk about that to make sure it's not going to become a hindrance or how to improve it. So when credit's pulled, they're in a good spot. And the final piece is, that they're just not ready. This is a fall purchase, but they want to chat now to make sure all their ducks are in line. So when they contact us, maybe in the summer to get ready for the fall, there's no surprises.
Right. But there's no downside to getting a pre-qual versus a pre-approved, right?
There's no, well, no one wants their credit pulled. Everybody thinks that inquiry on credit is going to hurt their scores. And that's a big misconception. That's not.
It is. Okay. All right, good.
And maybe I'll touch on that real quick, because that's a very common question.
Go ahead.
Don't pull my credit. Why? Well, it's going to hurt scores. Why? I read that online. Well, we all know reading a lot of things online, a lot of incorrect information. So yes, if you have your credit pulled, Yeah, thank you. Right. It's fake, I don't say fake news, but it's not accurate news, right? Media. And I think it really it comes down to if there's many inquiries in 2 consecutive 30-day periods, sure, that could hurt scores. So if you pull it 5 or 6 times now and 5 or 6 times 35, 45 days from now, that's a lot in a short period of time. But just one inquiry now, and you only need 1 pre-approval letter. You don't have to have 5 approval letters. As I tell my clients, 1 pre-approval letter doesn't commit you or obligate you to use that lender. You're not committed. You can certainly shop around later if you like after accepted offer, but just get that credit pulled once, get the pre-approval done, and it shouldn't hurt your scores. But again, everybody thinks it does.
So you said something I didn't know, or maybe I didn't understand what you said is that if I get a pre-approval from one bank or one financial institution, that's good for all?
Well, no, that's good for all your offers, right? So therefore,
gotcha.
It doesn't commit you to obligation to use that lender that pre-approved you. So, but you only need 1 pre-approval letter to go out and make an offer. A lot of people think I'm going to call 3 different banks, get 3 different pre-approval letters because they're all going to offer me something different. That's not typically the case. We all pretty much offer the same products within a decent sized box, but within that box still. So I tell people get 1 pre-approval letter if you're ready to have your credit pulled. And then after the accepted offer, if you feel you need to rate shop, that's the time to do it.
Gotcha. Okay. Oh, that sounds good. So my other question I always run into is, just because I get a pre-approval, it doesn't mean my loan is guaranteed. Is that correct?
That's absolutely correct. Yes. Yeah. And I'll if you don't mind me jumping in, I'll explain.
No, please jump in.
Because what if someone loses their job? Right.
Yeah, okay. Understood.
What if the property doesn't appraise at the purchase price, and the difference can't be made up between maybe lowering the purchase price or the buyer's putting more down, I should say.
Correct. Right.
Maybe that's an issue.
And that's why the lending institution usually requires your pay stubs, right before you close, and they kind of like a repeat of the documentation they ask in the beginning. So.
Yeah, we try to keep that minimal, but yes, we could circle back and say it's been a few months, and since we had your original pay stubs, let's get those in. Or we do a final verification of employment as well. To your point, added to that level of paperwork. It's just to make sure, again, you still have your job. Something else is maybe their credit has been destroyed. So maybe I had this happen once where someone maxed out all their credit cards after I pre-approved them, and lenders are required to do what's called a soft pull on credit right before we close to make sure they haven't incurred any new debt. We did a soft pull. Again, we're not getting the score. It's not a hard pull, but it's soft. Right. And this borrower had opened up 3 new cards and maxed out all of her other cards. So what do you think? Where do you think the credit scores went in doing all that? Exactly. And therefore, the underwriter then said, I want to repull credit here because this makes me nervous. We did. Her scores went down dramatically. She didn't close. Now, thankfully, that's the only story I have literally in 20 years of doing this where someone that we pre-approved didn't close, but it could happen.
Oh, okay. Okay. Yeah. No, it was always the question mark in the back of my head is, I'm pre-approved, but that doesn't guarantee. But I think you answered it fully. Great. So let's talk about some of the criteria. All right, let's say I get my pre-approval and then I say, okay, Rob, what exactly are you looking at? What criteria do you need to get that pre-approval?
Yeah, great question. So we do make sure that the borrower has a 2-year history of doing something, right? Okay. So not sitting on the couch, not working. Can people have gaps of employment? Sure, yes, as long as they're not incredibly long, typically.
Do you make a distinction? Excuse me. Do you make a distinction between self-employed versus salaried position? I guess you would.
No, I mean, if they're self-employed, we do make the distinction of needing typically 1, if not usually 2 years of tax returns being self-employed. So we know you have a little bit of a track record. You can't just leave your W-2 job today and then be self-employed in the next couple of months and call me up this summer and say, what do I qualify for? You don't even have a year's worth of self-employment history on tax returns. So that's a deal breaker for every lender. But the point is, yes, it's a 2-year view of doing something, be it W-2 or self-employed. Yes. I've had a lot of self-employed borrowers who were self-employed and then just said, it's not working for me. I'm going to go work for a company. They only started their job as a W-2 45 days ago. And they get worried. Well, wait, I was self-employed for the past 2 or 3 years. I just started as a W-2. Am I going to qualify? That's fine. because we just need 30 days of pay stubs with a W-2 job and documented 2-year history back to where that started. And they were doing something for the past 2 years. They were self-employed and now a W-2, but they've been working for 2 years, and that's okay. It's a challenge from W-2 to self-employed. That's where the flip is, where we need a little bit more history of self-employed.
So the standard for a W-2 wage earner is much lower than for self-employed.
Correct, because there's that guarantee from the employer, and then someone could argue and say, well, there's no guarantee of employment. What if they let me go? But there still is a guarantee that they have a job, and if they go to work every week and do a good job, they're hopefully going to maintain their job.
Okay.
So correct. Yeah, correct.
Makes sense.
So it is the 2-year look on work. It's also the acceptable credit scores. We need to see that they're not less than perfect and let's say sub 600, but they're at least 600 or greater. And some programs want 680 or greater. Every program is kind of different depending on your loan size and the program type. So we look at credit score, and the big other factors, we look at debt to income ratio, making sure the borrower's not in too much debt, because if they are in too much debt with the new mortgage, no matter how good their credit score is, no matter how wonderful their employment history is, they're not going to qualify.
Is there any of these factors like credit score versus minimum income levels or the debt to income ratio you mentioned? Is it weighted differently, or what, does one weight more than the others? Is one more important than the other? I guess I'm asking.
Yeah, they're all equally important, right?
Okay.
You have to have debt to income ratio is really to make sure you can qualify to borrow the money you want. So whether your debt to income ratio is rock bottom at 12%, or whether it's at the maximum, which there's a range of maximum depending on program, anywhere from 43% to 50%, pretty high maximum. As long as it's under the program's thresholds, even by a 0.01, that's still good. It doesn't mean the rate's going to be worse. It just means, okay, you qualify to borrow the money, your debt to income ratio is in an acceptable range, so you're good to go. So that's the only weight on DTI, as we call it, debt to income ratio.
Gotcha.
But credit score is really paramount, right? Because you can have a low debt to income ratio, but if you have bad credit, it doesn't make a difference.
Okay, you answered my question. Okay, gotcha. So credit score is king, basically. So.
And Rob, quick question. So for the DTI, is it the same for all the bank, for all the lender, or different?
Great question. It's different, absolutely. So if it's a jumbo loan, there's more risk in jumbo loans. And right now, by the way, in Eastern Massachusetts, and I'm a Metro West person as well, Boston Metro West for my clientele base as well, we're all in these expensive counties of Suffolk, Essex, Norfolk, Middlesex, et cetera. So a jumbo loan in those counties is 770, 500 or greater. So 770,500 or greater. If you're borrowing more, that loan, higher than that loan amount, I should say, the debt to income ratio is 43%. That is the most conservative you're going to hear because it's a jumbo loan. If you go into a non-jumbo program, we can actually potentially take someone's debt to income ratio up to 50%. So 8 percentage points higher, because there's a little less risk in the non-jumbo world. They're not borrowing as much, so hence less risk, and they will take a higher debt to income ratio.
Right, because in a jumbo world, you require a greater down payment. Is that correct?
Minimum with the investors in our portfolio, I'll speak from my knowledge with Fairway, 10% down minimum for a jumbo loan. And you can't have 600 credit scores. Typically needs to be roughly 680 or greater. So you have to have good to excellent credit. At Fairway with our programs, you cannot put 4% down, 3% down like you might with some other programs and get a jumbo loan. It's too risky for banks. And by the way, we have many banks in our portfolio. I'm only speaking of the banks we sell direct to Fannie Mae, Freddie Mac, and a lot of national and regional to New England banks and state banks in Massachusetts. I'm speaking for their guidelines strictly at this point.
When you said that, we talked about this a little bit before the call, is the down payment of less than 20%. I guess that was the gold standard. There's in the older days, that's what everyone used to put down. And I thought we got away from that back 2008 and prior. But then with all that legislation, I thought we had changed the law and kind of pushed it up, forcing people to put down more money because you got more skin in the game, because people were borrowing all this money without anything down. So I'm surprised. I guess I'm surprised to hear 10%. And I guess, how low can it go?
Hopefully not much lower. I do think we've hit the low for the moment because, you know, when the pandemic hit, certainly minimums went up briefly and credit score minimums went up. That was an immediate overnight knee-jerk reaction to what's happening in the markets, right? Where's this pandemic going to take us?
Gotcha.
But very quickly, within a few months, 3 to 4, 5 months after, we started seeing everything level back to where it was post the Great Recession, right? That was a rebuilding after the Great Recession of, obviously, we know the lending collapse and all those no doc loans. You know, to your point, you mentioned these kind of crazy stated income loans where you didn't even have to, you know, you just had to have, you didn't have to have a job for a no documentation.
Yeah, to show a pulse. That's all you had to do.
A pulse and a credit score and 20% down, and you can get a loan. You know, and we're surprised things went wrong then, really. You know, so now it's all full documentation loans, right? Which we need the borrower's documents, pay stubs, bank statements. That's the full doc loan. But I don't really think it's going to get any more lenient. I think it's lenient enough, but with some conservative behind it as well, I feel too.
Do you see any tightening in the market right now, given where, I guess, all the nervousness or uncertainty about interest rates, inflation? Are lenders like you or, you know, some of your competitors starting to tighten their standards?
Not yet. No,
not yet. Okay.
Yeah, you know, because the rates have gone up, so it means people's payments are going to go up a bit. But ultimately, we still have that debt to income ratio to follow, and that's still, you know, 42 to 45% is what I tell most of my borrowers. Try to stick in that range, depending on, or 43 to 45. You know, stick in that range, and no one ever wants to get that high anyway. No one wants to spend 42 to 45% of their gross monthly income on a mortgage payment.
Exactly.
So thankfully, most of my clients tend to be 20, 30% range, maybe 35. So we never even get up to that maximum, thankfully. But no, I haven't seen it. I haven't heard yet of any additional restrictions based on inflation, based on rates going up. No, not at the moment.
And just to be clear for people listening, that 42% includes debt, not just a mortgage debt, but any property taxes you have to pay and any other debts that you have.
That's exactly right. It's the entirety of the mortgage payment. So the taxes, the homeowner's insurance, if it's a condo fees, and of course, principal and interest you're borrowing. But Matt, to your point, there's also things like car payment, student loan, credit card. If you have these items, we don't care about the balance, believe it or not. I once spoke with a woman who was an attorney, and she had $200,000 of student loan debt, the highest I've ever seen in my career. Her monthly payment was about $1,200 a month. All we cared about was that $1,200 a monthly payment. Well, she made $250 a year. So she could handle the $1,200 monthly payment plus her 600K South Shore home. It worked out just fine. She wasn't aware of that. Most consumers think, I have $200,000 in student loan debt. Who's going to want to give me a mortgage?
Correct.
But it goes back to that minimum monthly payment of what's the minimum payment for that car, credit card, and student loan. Add that to the mortgage payment that I just mentioned, those items, and divide that into your gross monthly income. And that's how we calculate debt to income ratio.
Yeah, what I think people miss is that you're borrowing over a 30-year period, and that makes your payments pretty small. I've always argued for a 100-year loan, but no bank would give it to me. So,
someone emailed me last week to that point and said, "I heard the 40-year mortgage is coming back," and some small credit union we don't work with actually emailed him to say he doesn't even have a mortgage. You know, hey, there's a 40-year if you're interested. It's like 40 years, really? And
yeah, anyway. I mean, I joke with Ying about this all the time. Is if they could issue me a 100-year mortgage, I would take it in a heartbeat at these rates. And you imagine how low they are. Historically, they're very low. I mean, I hear people complaining. I'm like, what are you complaining about? Go back to the 80s, where, you know, I think you were part of that as well. And you know, mortgage rates were like 18%. You know, and you had Paul Volcker trying to burn inflation out of the economy. So it just got ugly. So I mean,
I think it's about perspective, right?
Yeah,
and they don't, you know, and to give you a quick case in point from the clients that didn't find a property last year, and I'm sure you're hearing this as well with your clients, you know, and they were in their head, they were in the low threes. And suddenly there may be high threes or maybe low fours, depending on your profile and the loan size and your credit score. And they're like, these are awful. But this is people, again, who last year knew of a lower rate. And I said, well, sure, your perspective is comparison. They might have gone up a half a point. Right. But, you know, for a $500,000 loan amount, you know, going up a half a point means $145 more in payment. That's it.
I know.
It's a lot to some people. I'm not trying to minimize that, but for a $500,000 loan, a half a point equates to $145 more a month. That's not usually going to put someone out of contention when they're looking for a home. They might just adjust their budget elsewhere a little bit.
Exactly.
They don't go out and eat out as much or something, right?
Get rid of Netflix,
They start cutting somewhere. It's perspective. Rates right now are back to where they were prior to COVID. COVID pushed them down. And why wouldn't it? It was a worldwide pandemic, so no surprise. But we've gravitated back to where they were before, which is no surprise. 2 years later, and they are still really great rates, regardless. So thank you for your perspective of the teens that our parents saw, right? And whatnot. I've heard those stories.
Yeah, no, I remember that. So, but anyway, the other thing is we deal with a lot of empty nesters and people that are contemplating moving because their income has become constrained or limited because they stopped working, but they have all these assets. And one potential seller that we're talking to said, well, I don't want to sell because my credit's bad and I can't buy a house. I can't get a loan. And I said, well, what about the cash bonanza that you built up over the last 30 years? Because you paid it off. He's like, yeah. So how do you guys look at debt to income versus an asset loan? I don't know if that's the right way to call it, but
sure. Yeah, asset depletion. So you had the correct word there. We look at someone's assets and kind of amortize them over a 30-year period and divide and figure out what could we use from that asset. I'll give you an example. If you have $1 million in the bank, we can deplete that, so to speak, in our formula calculation to give the borrower roughly about $2,800 a month on the application as income. Even though they're not pulling out $2,800 a month, they don't need to. We're going to qualify them, assuming as if they would. And so we're going to put on their income on their mortgage application $2,800. That's if someone has that much money in the bank, they might want a nice home. That might not qualify them for the home at just giving them $2,800, because if they don't have Social Security income or pension income or no other sources, just the asset, that's probably not going to be enough, right?
Right.
Unless they want to buy a couple $100,000 property, sure, maybe, right? But and by the way, I mentioned earlier we sell to Fannie Mae and Freddie Mac. These are these quasi-governmental organizations that oversee lending in the U.S. and they both have different guidelines. Some of them are the same, sometimes some differ.
Right.
Well, one asset depletes Fannie at $1 million and gives you about $2,800 a month. Freddie Mac asset depletes and would give you roughly about $4,100 a month. So two different agencies, two different ways to asset deplete that same asset and getting this monthly income we can use. But the catch with the higher number I just mentioned is you have to be 62 years of age or older to qualify for this. Well, usually when people are that age, they're probably downsizing, potentially. So maybe this is a good product for someone who's downsizing. For those that, I don't know how old your client is that you spoke with, you mentioned, I think that they have less than perfect credit. I believe you said that's a challenge with asset depletion. They want credit scores usually of about 720 or higher, because they want to make sure someone has good credit if we're going to do this out of the box program to deplete assets to qualify, because that is definitely a niche program.
So again, credit score is king, exactly. whether debt income or asset depletion, credit score is king. And what is a score that's credit score that really shuts you out of the market altogether?
At Fairway right now, we go as low as 580 for FHA, for the Federal Housing Administration's program. Keep in mind, the rate's not going to be great because of where those scores are. But that's as low there. Every other program, non-government lending program, FHA is one of those government lending programs, 600. So again, quick answer, 580 to 600, depending on the program.
Gotcha. Okay, that's good to know. So what was I going to ask next was, so we talked about down payments, difference between debt to income, asset depletion. Okay, and then maybe do you have any other questions on that? Or
Rob,
go ahead.
Have you mentioned before Fairway had the special program for pre-approval?
That's right.
Would you be able to introduce?
Sure, please. Yeah, I'm happy to. Yeah, it's sorry to jump in there. Fairway Advantage is the name of the program. And it is a conditional approval program. So I define this as one step better than a pre-approval, where we actually take a borrower's file through processing and underwriting. So I'm sure you're used to clients who, you get your accepted offers with your clients with a pre-approval, and the next steps for them is they're going to get assigned to a processor who takes a look at the file. Then that file goes to underwriting, and the underwriter, again, is the person who, for the listeners, who puts that final stamp of approval on the file, and then get ready to close the loan and fund and close the loan. Well, what we do is, before the borrower theoretically has even looked for a property, we can first get them pre-approved. That's the first step. And then we actually put them through processing and underwriting before they even make an offer to get this conditional approval. So what I love about this program is there's no cost, there's no obligation, and it's a great letter to have to possibly give somebody an edge in this market. Because I'm curious of what your listings of what percentage you see pre-approval versus conditional approval, but I've heard that it's kind of an 85-15 mix, whereas most people are giving still pre-approvals, which are solid and great to use to get an offer accepted. There's nothing wrong with a pre-approval. And only about 15% of offers out there for a property are coming with this conditional approval. I don't know, what have you seen for your listings of offers that you're viewing? Do you see that same percentage split? I'm curious.
Yeah, you want to comment?
Yeah, most of them are just a pre-approval.
Okay.
Yeah, we got some cash offer right now. Yeah, and also there are some, I know there are a couple of brokerage, they are doing cash offer in certain way. The buyer is not cash, but they wrap it as a cash offer. That's something we want to be able to compete with that. That's when you're talking about Fairway Advantage. I think it's a great program that we can help the buyers prepare. They are actually similar as cash offer, except that they, it's not really cash in the bank. The proof of fund is not the bank statement, but your approval letter.
Which is one step above the pre-approval, is what you're saying, right?
That's exactly right. It's conditional, so there are some conditions on it, but it's obvious conditions that you'll recognize, and they should be on there because they don't have a property yet. The appraisal, they don't even have a property, so how can we do the appraisal? Homeowners insurance, because again, they don't have a property, so how can they get homeowners insurance? And then final verification of employment, which we do for every loan anyway, to make sure the borrower still has their job. I just issued one this morning, and they were the 3 conditions on there. And the signed purchase and sale, of course, we need the sales contract. They were the 4 conditions, I should say, on there, but that's it. So I'm excited because they may be going out this weekend, and hopefully, since to your point, you don't see as many conditional approvals as pre-approvals, maybe this will give them that edge, right? If someone's paying $850 cash and my buyers are $800 with this letter, well, there's no choice. You're going to take the cash.
I think when you have like close to a tie, you need something to differentiate. That might do it. So
that's right. That's right. There you go. Well said.
Yeah, no, I think that's right.
So is the Fairway Advantage is a stamp, or how do you
market it, I guess?
Right.
Yeah. So the last page of the letter actually says, "Dear agent, we want to reassure you that this has actually been through underwriting with a Fairway underwriter. They have reviewed the file thoroughly, and there's only the conditions we list here. Nothing else is needed. This is very solid approval or conditional approval. We look forward to working with you." We did a national ad campaign last year across all the major cities in the US. And that did get a lot of recognition. Actually, my friends were calling me up mentioning the ads, and I hadn't seen half of them myself. So that was exciting. But ultimately, it's the letter that with your help in mind, with the agent's help in mind, letting the listing agent know, hey, read page 3, read this letter. This is not your standard pre-approval letter. We can even close quicker, by the way, because borrowers already spent a couple of weeks going through processing and underwriting. And isn't that maybe a help as well? Maybe another edge. But it's the letter.
How many days? How many days for closing right now? If I got a pre-approved by the Fairway Advantage.
Sure. We can close in about 2.5 to 3.5 weeks, depending. It's quicker than
awesome.
That's good.
We may have to rush the appraisal, to be fair. And if it's a condo, we might have to all hands on deck to get that condo questionnaire filled out by the management company. Or sometimes they can take forever, and that's we're waiting for them. We're in their mercy, I should say, but we can close very, very quickly.
Yeah, we're dealing with that right now with one association. They move at their own pace.
Yeah, that
That'll
brings us to another question, Rob. We talked about that there's a new questionnaire for condos, especially for the deferred assessment.
That's
Would
right.
you, talk a little bit about that?
Yeah, so with the unfortunate tragedy of the Champlain Towers, actually here where I am in Miami Beach at Surfside, everything dramatically changed this year when Fannie Freddie rolled out their new guidelines. And it's all about safety and soundness, of course, of these buildings, right? They had deferred maintenance items there that weren't addressed, obviously the concrete and the foundation, which caused the collapse. And so now every condo questionnaire, by the way, this is 5 or more unit association. This is not your 2, 3, or 4 unit associations. So I know very popular, let's say, Southie or Dorchester, we have these, 2, 3 unit, not those. Definitely 5 or more units, they're going to get this questionnaire, whether it's existing condo, new condo, any condo, and it's going to ask about deferred maintenance. And there's, is there any known deferred maintenance? And if they say yes, there's a barrage of additional questions to ask about. No surprise, right? What are they? Is there a special assessment for this? Has this been addressed? There's a lot of talk about this 30 and 40-year certification that a lot of condos are taking the initiative to do to kind of pass this big checklist of questions. So this way, there are sellers that are selling in the condo or buyers that are coming in or refinancing. They can just say, here's our 30 and 40-year certification. We're good to go. It's kind of the gold standard, if you will, to say this condo has that stamp of approval of soundness and,
Sounds like we created a new business opportunity for somebody. So
right. Absolutely. Yeah. I'm sure these engineers and the folks that are doing these certifications are slammed right now. So, the good news is, while this question hasn't always been on there, and it wasn't on there in the past, I should say, Surfside is what brought it to everybody's attention. But typically, we don't see condos, in my experience over these years, I don't see a lot of condos with special assessments. Usually they're kind of keeping up to date on things and you taking it from their reserve fund, perhaps, and fixing things as they go and keeping on top of things. It was just this one example, and unfortunately, deaths that ensued that has now set this precedent nationwide. So bottom line is, if something comes up on the questionnaire that's answered as a deferred maintenance, we just need more information. What is it? Was it addressed? Do you have the money for it? Let's see your budget, your reserves to make sure this can be paid. And if it's too concerning of the item, then we might not be able to close. It might have to get addressed before anyone could sell their unit, or refinance their unit if they're existing owners. It could be a stumbling block for everybody in the association. So certainly all the members of the association have a vested interest to make sure that their condo is up to date.
Yeah, you and I talked briefly on the phone yesterday about the Title V issue I had with this shared septic system that they use, and that was causing trouble for the loan underwriter. And I think we finally got it settled, but it's just because you have no control over it. You're dependent on the HOA. So
that's right. That's right.
You mentioned something that really intrigued me. Was you mentioned Fannie, Freddie, and FHA. So it sounds like you, as an underwriter, when you get a loan application, based on what the buyer wants to do, has a menu of options or programs you could slot somebody into.
That's right.
And I guess that I never thought about it that way, but it gives you a lot of, flexibility or creativity to get somebody approved. Because maybe I'm only putting down 5%, so maybe you qualify for here, but here you're going to put down payment, so maybe I can put you over here. It's not just about getting the best rate; it's about maybe getting a loan. So
that's right. That's right. Yeah, we do call ourselves loan advisors. So we're here to advise about the best program out there. So this job. Before I got into tech, it's a quick side story. I'll bring my dad in. Before I got into starting mortgages, I was in tech. And, in the tech days, there's always companies popping up. When .com was popping up, I'm dating myself here. And, there's always company, and all my coworkers are jumping from company to company to company. Lots of movement. And my dad said, Rob, how you don't keep a job that long. You're at one company for 2 years, then you're another company for 2 years. I'm like, yeah, there's all these great stock options and great companies. I want to bounce around and find the best opportunity and think I'm going to become a millionaire, right? Exactly. All the dreams they promised back when
you watched the movie Wall Street, you got excited and you decided to see if you could.
That's right.
Seize the day,
It didn't happen because I'm still here working. That millionaire dream did not. But the point is, with mortgages, every borrower is so uniquely different. And it's kept me enthralled for 20 years because everyone's profile is different between their down payment, their credit score, their work history, where the money's coming from, the type of property they're buying. We have to make sure we fit all these things in to make it work. As you may know, for example, FHA is not great with condos. The condo has to be FHA approved, and so few condos are anymore that if someone has bad credit and low down payment and has to go FHA, not the only reason to go FHA, but let's say that's where we typically fit them. I hope and pray they're looking for a single family home, because if they want a condo, we might not have an option for them, because again, it's fitting them into this right slot, so to speak, of the best program or programs, plural, that fits for them. And that's what I love every day. It's never a dull moment.
Yeah, no, but that seems like a pretty valuable service that you offer there, or you could offer, is when you do that pre-approval for a loan applicant, is to say, and you learn more about what they're trying to do. Maybe they're looking at condos and say, well, no, you should be looking at single families because I can get you a loan. If you do it there, here it's going to be harder. So does that kind of conversation go on much, or?
Absolutely. Yeah. And it typically goes on with people who are open to either or, because I find if someone has condo in their mind, no matter what, they don't want the maintenance of the yard, or they want a cheaper property, because that's theoretically they could be cheaper, not always, of course. But it does. It's all those conversations of getting to know them, their goals, their short and long-term goals for holding the property. As I'm sure you ask the same questions, how long do you plan to be in this property for? Are you going to have a family? Are you going to grow here?
Exactly.
Or if not, then maybe we'll put you in this community or that community. I'm sure if I'm, don't have any children or intend to, I might not need to go to one community that has these top schools. They may go to a community that the schools are good, but not top, and I'm paying less property taxes. It's that same, I think, excitement you probably get out of putting your borrowers into the right fit for them, and we have the same exact conversations.
Yeah, no. You feel like a good Samaritan when it all works out. So
well said.
So I think the next topic, unless you have anything else to ask on that.
I'm good on that. Yeah, thank you.
Is we talked about this. What could go wrong? We talked about, okay, you lose your job, that's one thing. But what are some of the things that could go wrong in terms of derailing the loan application, even though you were pre-approved?
Sure. Well, let's go back to your septic example first to start, right? It's rare that condos have septic, but you've come in touch with that situation, and I have about 6 months ago. But single family homes and the burbs, a lot of them have septic, right? So if it's not passed the test, or if it doesn't pass the test, where the seller thinks it's going to be fine and not, that may have to get fixed before closing, or if not, it has to be a renovation loan for the borrower to get a loan that allows to fix the septic after the fact, right? Septic aside, if it's a condo, we have to issue what's called a condo warranty. The condo warranty means that the condo has passed muster. So even though my borrower's credit file may be stellar, if the condo warranty doesn't get issued because deferred maintenance, we just spoke about that, right? What if there's some unknown deferred maintenance issues? What if there's some pending litigation against the association that no one knew about? Maybe the listing didn't know. That could be a deal breaker. What if one person owns too many units in the association? That's rarely comes up anymore, but if someone in a 50-unit association owns 20 units, it's a lot of units, I know, that may not qualify for standard Fannie Mae, Freddie Mac. It won't actually qualify for standard Fannie Mae, Freddie Mac.
Why would that be? What's the logic behind that?
So it's somebody owns too many units and can have too much say over the association and drive the association in a direction that no one's happy with in the complex. And then maybe
a concentration issue then. Okay. Yeah.
That's right. Okay. That's right. And then maybe suddenly no one wants to pay their mortgage because they want out. And then it's not a stable complex anymore, so to speak, financially, or, people selling, not structurally, to be clear.
Do you look at, do you look at vacancy rates in condos? Because I remember back in, I think 2008, and this was more of a Florida issue.
That's right.
Yeah, where there were like condos had a vacancy rate of 50% or something, some ridiculous number. And therefore, the burden of the association fees fell on a smaller group or a pool of people.
Yeah, I have not seen that up north, thankfully, in the Northeast where
No, not up north. No,
where I have my license. Yeah, so no. The only thing we care about for occupancy is new construction properties. How many are owner occupied or second homes by the time our borrower's unit closes? If it's too low, we might not be able to assist. They might have to go to a niche lender to assist if it's very low owner occupancy. But as we know, there's no inventory out there. So we really haven't had that problem in a while.
Right,
even on new
right.
construction, the units go like hotcakes. So we know by the time our borrowers close, they're going to have at least 50% or greater owner occupancy or second homes, and there's not an issue. So thankfully, occupancy hasn't hurt a deal yet. But sure, back in the day in Florida, that was definitely a showstopper for many folks financing. I'm trying to think what else are the big showstoppers for what could go wrong. You know, I mentioned destroying credit, mentioned losing the job, those things. They're the big
unsettled lien. What about unsettled liens on a title that you're purchasing?
Great
Is
point.
that it? Let's say, you know, let's say I see a property and I realize, and I, the buyer, realize or understand that I'm going to be assuming these liens. I guess you would just take that. I guess you could factor it into your DTI calculation. Is that DTI debt?
We need the attorney, the closing attorney needs to make sure there's clear and clean title before we close. So
Okay.
that could pop up. Again, I'll do statistically from my experience, only once in my time was a title could not be cleared up. There's too many liens that weren't discharged is the way that the attorneys would say it. And it was taking months and months to figure out where all the discharges were. Did it happen? Did it not happen? And my borrowers just gave up and found another property. So
Right.
that was a surprise that no one knew up front. I would imagine the sellers thought we're good to go. What was a house from the 1800s? A lot of history there that changed hands a lot of times. So yes, that is a great point about liens. That could cause a problem.
Right. So what I'm hearing is that you can't really settle a loan until everything's cleared up on a title. Right?
That's right. Title's cleared up. All the borrower's conditions are cleared up, and everything looks good from the property side, the collateral side, and then the credit side, the borrower's profile. Correct.
Okay. Good.
Right.
Okay. So I think we tackled that issue.
Yeah, I have been always tell my buyers, after you apply a loan and your loan is in process, don't go buy any big, expensive stuff, not another car, don't co-sign another loan, don't just put too much money right away, because that happens to not a young first-time home buyers. They have parents to support them. They deposit a lot of money to the bank, and
right.
that will be potential issue too, right?
If the money's coming over from the parents as part of the assets, as long as it's documented properly, hopefully it should not be an issue, I should say.
Okay.
Which is good. Yeah. So in a non-jumbo world, the parents could give $1 or could give the entire down payment. We just have to have a gift letter filled out, documentation to show where that money came from. And by the way, really more than 50% of the gross monthly income of the borrowers on the application needs to be explained if there's a deposit larger than that. So everything is sourced in our industry. Where did it come from? We want to make sure it's a legitimate sourcing to your question on that. And so the only caveat is if it's a jumbo loan, most jumbo banks want the borrowers to put at least 5% of their own funds into the transaction before they get the gift from family. So the family just can't give the entire gift sometimes, not all jumbo investors, but some of them. So there are some niches and caveats. I don't want to get too in the weeds on that, but just to say that bank by bank, there could be some quirks around it, but it's, to your point, it's great to be very mindful of these monies coming over and make sure that your lender is okay with it for the program.
Okay, just a clarification on the DTI ratio. Is it based on gross income or net income, net of taxes?
Gross.
Okay, it is. Okay, right.
It is. For a W-2, it's gross. For a self-employed, it's adjusted gross, which would be net. Because self-employed, we need to see what their expenses they're writing off to know what they're really bringing home. Whereas a W-2 employer theoretically doesn't have the same expenses because their company is probably paying for them if they have any expenses, like an expense account. So they don't have that. It's interesting how it's a little bit of a discriminatory, not an equal view of that. Again,
It
gross,
isn't an equal.
right?
No, you're right. Yeah.
It's great, but does the W-2 bar have expenses? Of course they do, but not usually work related typically. So that's why it's again gross on W-2 and adjusted gross or translation net on self-employed. For better or for worse, they're not my rules, of course. Welcome to Fannie Mae and Freddie Mac's guidelines.
Yeah. Well, it sounds like you have a lot of constituents that you have to play by, that has given you a lot of rules you're going to play by. So you probably have some type of computer in your office that can arbitrage all this stuff. So you stick an application in it and you go here, So
Constantly checking guidelines, right, to make sure that nothing's changed, right? We're not going to get caught and not have any last minute surprises. But yes, it's never a dull moment.
Well, this has been great, Rob. Do you have any other questions for Rob Ying or?
I'm all set. I'm good. We can have maybe another session. Rob, I was thinking about investors, investment loan. That will be a great topic maybe next time.
Absolutely. Yeah, I
Good.
love that. Yeah.
And we'll include all your contact information below if that's okay with you, in case somebody wants to seek out an advisor.
Absolutely. I appreciate that. Thank you again for the opportunity and the invite. This was wonderful.
Yeah, no, I learned a lot. So I think we need to
Same here.
pull some cash together and go buy a house and talk to Rob, So.
Phone lines are ready whenever.
All right. Well, listen, don't let me take you away from your beach time. I know that's very important.
See, you've already fallen into that perception. I love it.
And give that dog a big hug for me, because I heard him in the background. He needs a lot of love. So
Thank you.
Lovable dog. But I will thank you both and have a wonderful weekend.
all right, you too. Thanks again,
Have a
Rob.
good weekend. Bye-bye.
Thank you both.